PE ratio, price earnings ratio, is one of the most used and most misunderstood numbers for investors, especially when looking at a quote like this on Yahoo Finance. The P, the price, and the E is the earnings per share. You divide the P by the E to equal PE ratio. So, $10 stock with $1 in earnings has a 10 PE. Who uses this number? Why should you care? And what do I pay attention to when making $1 million decisions? Look, the PE number is often quoted online based on trailing information, and I'm interested in buying based on the future potential. Because a company might have a big tax write-off or some temporary blip, which causes their recent earnings to be affected. So this requires digging and doing your work before buying. A company has steady earnings. Look at the trailing PE gives me a sense of historically what that company has been valued at within the marketplace. Example, energy and utility stocks are often associated with a trading PE range of 6 to 12. Bank stocks are very similar. What I look for is forward earnings for stocks that have potential to meet earnings estimates and still be trading at a bargain PE ratio, maybe relative to the S&P 500 or their peer group. For example, if you have 8 bank stocks all trading for around 10 times earnings, forward earnings, and then you find one bank stock you like trading for 6 times for future earnings, then that stock might be a value bargain relative to others. PE ratio is just one tool, one indicator. There are more covered in my video on valuations.